Welcome to today's episode of Silicon Bytes, and I think this is going to be an interesting one. We've been talking for the last 2 years about how the Russian economy, long term, may not be able to cope with Putin's relentless war. Well, it seems that the cracks are starting to show. Before we jump in, thank you to everybody who supports the channel, especially those who've become a patron, bought me a coffee, or supported in that way. It is incredibly important to help keep the work up that we do every day to put these videos out and to analyze what is happening in Russia's illegal and brutal war against Ukraine. Now, let's get into the topic. Today, we're diving deep into the growing trouble inside Russia's war economy. Kremlin officials still speak of resilience and momentum. The war machine continues to crank out lethal munitions to add to the pile of trauma and scrap metal in Ukraine. But scratch the surface, and the cracks are hard to ignore. Let's dive into the story. Since Russia launched its full-scale invasion of Ukraine in 2022, it's become the most sanctioned nation on earth. Yet against all odds, its economy has shown a defiant resilience based on certain metrics. According to official Russian figures, growth in 2024 outpaced all G7 nations. The economy expanded 4.3% compared with just 1.1% in the UK and 2.8% in the US. But firstly, official Russian bank figures have become increasingly questionable throughout the course of the war. And that growth, in any case, is driven almost entirely by record-breaking military spending, not the consumer economy. There is the potential that this spending has also built up huge off-books financial risk or a debt bubble. Just as the war is not politically or militarily rational in a classical Western sense, it turns out to neither be economically rational too. Since Russia's full-scale invasion of Ukraine in February 2022, the state of the economy has been secondary to the goal of winning the war against Ukraine. That is the Kremlin's overarching priority. On Friday, the Kremlin leader delivered the keynote speech at the forum's plenary session. It focused on the economy but got diverted off topic in some crucial ways. "We have an old rule," Putin smugly declared. "Where the foot of a Russian soldier steps, that's ours." Well, Russian soldiers have been in a lot of places, including Berlin and Paris. Imagine you're the leader of a country hosting an economic forum, and actually you are desperate for foreign investment and cooperation, boasting about your army seizing foreign lands. That's not exactly the most effective way to attract business people and investment. However, factories are churning out reconditioned tanks, artillery, drones, and projectiles of various sorts at record levels. Oil exports redirected to China and India continue to fund the war machine. A shadow fleet of tankers helps Russia dodge sanctions. The country's oil exports by volume have also remained relatively stable, as supplies once destined for Europe have been diverted to China and India. But globally, oil prices have fallen back this year before the current conflict between Israel and Iran caused a spike, and it may well be the long-term trend is for declining oil prices. Then there's the ruble, judged to be the world's best performing currency this year by the Bank of America, with gains of more than 40% according to publicly released figures. But ask Russian consumers if they feel richer. The answer, if they're not too afraid to respond, would be that few feel that things are getting better. Indeed, high personal debt and lack of opportunities to earn are ways in which the Kremlin can channel some of its people into the army to sign contracts with the military to be sent to Ukraine to kill and die for money. 2025 paints a more complicated picture. Inflation has stayed high and interest rates have spiked to 20%. That's the official rates there. Businesses are struggling to find workers, with more than 2 million people missing from the labour market. Many, of course, are at war or have fled to avoid it, or have already been killed or badly injured. Russia's economy minister recently warned the country is on the verge of recession after overheating on war spending. And oil revenues, well, that's down 35% year on year in May. Analysts are blunt. Even if the collapse hasn't come yet, the signs are there. Andras Toth Zifra says they have this large pot of expenditure for the military that can't be touched, which means public investment is suffering. Roads, utilities, railways left underfunded. That means that when natural calamities come, as they almost invariably do in Russia, such as floods, wildfires, and other problems, there are neither the specialists to deal with it nor the equipment that they require. At the 2025 St. Petersburg Economic Forum, the contrast was glaring. Russia's top brass sounded confident. President Putin quoted Mark Twain. "Rumors of my death are greatly exaggerated," he said, meaning the economy. But beneath that bravado, the anxiety was unmistakable. Finance Minister Anton Siluanov is scrambling to fill budget gaps. So far this year, the government has borrowed more than half its annual plan. Bond yields are punishing, some over 15%, and the deficit is already near $50 billion. What about Russia's liquid reserves? These are shrinking fast, and even with emergency borrowing, many worry that storm clouds are gathering faster than the Kremlin can react. Yevgeny Nadorshin, an economist based in Moscow, tells the BBC News that overall it will be a pretty uncomfortable situation until late 2026, and definitely there will be defaults and bankruptcies. He and others see reasons for concern because Russia appears to have entered a period of stagnation. At the forum, Russia's Minister for Economic Development, Maxim Reshetnikov, warned that the country's economy was teetering on the brink of recession. We grew for 2 years at a fairly high pace because unused resources were activated, said Russian Central Bank Governor Elvira Nabiullina. We need to understand that many of those resources have truly been exhausted. Russia's finance ministry is aggressively increasing its borrowing in a bid to cover the growing fiscal gaps and hedge against an increasingly uncertain economic future as military spending surges and oil and gas revenues slump. 6 months into 2025, the ministry has already borrowed more than 2.7 trillion rubles. That's approximately $35 billion, or 56% of its annual borrowing plan. This week alone, it raised 195 billion rubles, around $2.5 billion, through 2 new issues of government bonds known as OFZs, hitting its second quarter fundraising target of 1.3 trillion rubles. That's $16.9 billion. Russia is paying steep yields, as I said, 15.2% on 6-year bonds and 15.5% on 11-year debt, amid high interest rates aimed at taming rampant inflation. Sberbank CEO German Gref warned Friday that the combination of high interest rates and an overvalued ruble was creating a perfect storm that could stunt investment and weigh down on Russia's economic growth in years ahead. We're facing a large set of problems that can be called a perfect storm, Gref said during a Sberbank-organized breakfast at the annual St. Petersburg International Economic Forum. That's a threat to economic growth, not only this year, but also for the next 2 or 3 years, Gref said, predicting the central bank would cut the rate to 15% by the end of the year. And yet some people insist that Russia can keep the war going indefinitely to the end of 26, 27, or further. These economic indicators would suggest this is not the case. Foreign direct investment in Russia fell to just $3.3 billion in 2024, its lowest level since 2001, according to new data published by the United Nations Conference on Trade and Development. The data released during Russia's flagship international forum shows a 62.8% decline in investment between 2023 and 2024, and a 50% drop from the pre-war level of 2021, when Russia attracted $38.8 billion. Even if the war were to end tomorrow, few serious businesses would consider Russia as an attractive investment destination, given the political risks that would remain. Sergei Alexashenko, a former deputy governor of the Russian Central Bank who now lives abroad, told Reuters, "I think it's clear you have to have some sort of an end to the conflict before American companies are going to seriously consider going back," said Robert Agee, president of the American Chamber of Commerce in Russia. Analysts point to a rise in state seizures, of private assets, including the recent nationalization of Moscow's Domodedovo airport, as a deterrent to foreign investors. In total, more than a dozen foreign-owned businesses have been expropriated since the start of the war. Last month, Putin said Western tech companies still operating in Russia, but acting against the country's interests, should be strangled. Again, this is not a particularly positive sign for foreign investors. It's not exactly inviting. Everyone can clearly see the situation with property rights is getting worse every day, Alexashenko also told Reuters. There's a deeper reckoning unfolding as well. Military casualties have surpassed 1 million. The state now pays massive enlistment bonuses, some regions offering $40,000 just to sign up. That's nearly 4 times the average annual wage. Analyst George Barros calls it what it is, a system not sustainable. Bonuses alone may cost $24 million a day to the Russian exchequer. And with 35,000 to 45,000 new troops needed monthly, the burn rate is explosive. Putin avoided full mobilization after 2022 protests. Instead, the Kremlin pays men to fight, kill, and die. But this social contract is straining, and so is the economy that's not really built to uphold this level of expenditure. Russian companies are struggling to import technology they need as well to maintain economic productivity, and it has badly damaged industries such as the car industry. The EU has also banned imports of Russian coal and diversified away from its gas with a view to phasing out imports by 2027. None of this is likely to seriously impede Russia's ability to wage war in the short term, said Mr. Toth Sifra, but it could affect the economy's ability to grow or diversify in years to come. Russia's mounting losses throughout the war created a double-edged problem. More and more replacements are needed, but attracting them to what was clearly such a high-risk endeavor necessitated increasing rewards. The solution: keep offering more and more and more money. Sign-up bonuses have ballooned. There are some oblasts in central Russia that are offering up to $40,000, 3 million rubles plus, just for a one-time sign-up bonus, Barros said. So what happens next? The answer is that not even experts know, neither Russian experts nor foreign ones. Some believe that peace will be inevitable when Russia can no longer afford to fight. But what kind of peace? A freezing of the conflict, which President Trump is thought to be exerting pressure to deliver, although the pressure seems to mostly be placed on Ukrainian leadership rather than the aggressor in that particular process. But Putin does not talk or act as a person who is seeking peace or with any kind of equitable settlement in mind. He talked again at the Economic Forum about how Ukraine and Russia are the same, and he laid claim to the entire country of Ukraine and all of its assets. The US may be wavering on sanctions against Russia, but Europe is holding the line on those sanctions regardless. Experts like Dr. Katya Yefimova say it's next to impossible to imagine a return to pre-war energy dependency on Russia. Meanwhile, foreign investment has dried up. The UN says FDI in Russia is now at its lowest level since 2001. Western companies are staying out, and they're likely to stay out for a long time, even when the war comes to an end. And with the state seizing more private assets, even those willing to return are starting to think twice. Operating a business somewhere where thugs have impunity and there is no tangible rule of law, that is not an ideal business environment. Inflation is still double the central bank's target. That is the official rate. Unofficially, it is thought to be far, far higher, and borrowing is surging. The ruble's strength, once a point of pride, is now hurting exporters and hurting consumers too, potentially. Economist German Greff calls it the perfect storm. Loose fiscal policy, high rates, and real wage pressures all converging. The Kremlin may have kept the engine running longer than many thought possible, but signs of fatigue are mounting, from battlefield attrition to the fiscal strain, from public service cutbacks to mounting debt. The war economy is grinding forward, but for how long? As George Barros puts it, Vladimir Putin today is writing checks that Vladimir Putin in a year or two from now may not be able to cash.